With the S&P 500 trading at its 2021 high of 22 times forward earnings, it's very, very challenging to find an amazing quality company that's trading at fair value, or even better, that's trading at an undervalued price that could potentially deliver 20-25% a year for the next 5, 10, 15 years. But I do have this opportunity today that I'm going to share, and this is a stock that so many of you have asked me to do a deeper dive on, to do a full video dedicated to this specific investment. And I'm sure many of you guys are going to enjoy it. It's an amazing company, amazing CEO, and I don't like to use this word, but I would call this company easy money. They have such an amazing business model. AI is not going to disrupt it. Nothing's going to disrupt it. It's going to be here 5 years from now, 10 years from now, 15 years from now, and maybe even 20 years from now. And this company is BN, which is Brookfield Corporation. The stock is only up 8% year to date, but so far the fundamentals are up way beyond 8%. In fact, around 20-25%. So it's been going really well, and the price has yet to catch up to the fundamentals of the company. Now, with Brookfield, you have an amazing CEO, which is Bruce Flatt, and they call him the Buffett of Canada, the Canadian Warren Buffett. He has an amazing track record, and he has led Brookfield. And Brookfield, as a company, has returned 19% a year for the last 25 years. This is more than Amazon, more than LVMH, more than Berkshire Hathaway, more than Walmart, and more than the S&P 500 itself. The total return of Brookfield is 13,873%. Now, Brookfield itself is a very complicated entity or conglomerate, you could say. And no matter how much research you're going to do, you really cannot treat this investment the same way you would treat maybe Google, or you would treat something like Visa. You cannot understand every tiny number about every single detail. That's not how it works. With this one, you can do as much research as possible, but at the end of the day, it's mainly a bet on the management, and it's a bet on the capital allocation and the potential of the management team and the reputation of the company in general. But the business in general is split into three different pieces. The first one is the asset management business. Then they have wealth solutions. Then they have the operating businesses. Now, the asset management business, which is BAM, I believe they own 73% of the company. Now, I'm going to analyze BAM by itself, let you know if BAM is a buy, and then compare BAM to BN and let you know which one is better, and value the whole company together. So it's like BAM and BN both in the same video. But for BAM, Brookfield Asset Management, this is an asset management business, kind of like BlackRock and other asset managers. They have money coming in from, you could say, endowment funds, from college funds, from institutional investors, from insurance companies, from sovereign wealth funds, where they're looking for a higher return for alternative investments. And a lot of those funds, they go through BlackRock, and some of them go through Brookfield Asset Management for seeking higher returns than traditional means. And BAM, it took them 25 years to get their first trillion of AUM, asset under management. Now they expect them to only take 5 years to get the next asset, 1 trillion in asset under management. So they expect 2 trillion within the next 5 years. This is massive, massive scale. And the law of large number and the law of compounding is going to work in the favor of BAM in a major way over the next few years. Now, many of you might believe that $1 trillion or $2 trillion is a lot. It's really not a lot. I mean, today, if you look at the total, you could say, addressable market, it's 150 trillion worth of capital. Alternatives, where Brookfield is, they got 15% market share, or 25 trillion. Out of the 25 trillion, only 1 trillion belongs to Brookfield Asset Management. So they don't even have a 10% market share. You know, this is absolutely insane numbers, what we're talking about. By 2032, they expect 300 trillion in global asset under management, and alternatives will likely have 60 trillion out of it. And Brookfield should have massive room for runways in terms of growth in their asset under management for the company. And the company takes those funds and they invest them in renewables, infrastructure, private equity, real estate, credits. They also own, I believe, 74% of Oaktree, which has been founded by the popular investor Howard Marks. Many of you may know him. They own a large percentage of Oaktree for credit investment and other kind of things. And this is mainly an asset-light Easy business model. And they collect money in two ways. The first one is they collect money on fees for managing the capital. The same way you put your money with a fund manager and they collect a specific fee, no matter if the market goes up and down, they're gonna collect this fee. BAM will collect the fee on $1 trillion that they have in this fund. Okay. The second way they make money is through carried interest. Carried interest is, let's say, for example, they have a target of hitting a 15% return 3 years from now. If they exceed the 15% return, they get a bonus. It's like an extra payment because they exceeded their targeted return. It's also called carried interest. It's pretty much like a Visa kind of business model. If you look at the income statement, you can judge it yourself. A 10-year-old or a 12-year-old can read the income statement. This is how simple Brookfield Asset Management is. I call it a toll bridge, where the money goes in and then they just put up their fees, and it's just so simple. Like if you look at it, they have $1.3 billion in fee revenues, which is up 17%. Direct costs are only up 9%, half of that, which is beautiful. Then they take out some money that's not attributable to BAM, to other kind of entities. You have fee-related earnings of $698 million, which is up 26%. Then they take out some cash taxes. They add back some stock-based compensation and investments from other income, because BAM reinvests some of its cash as a partnership within their funds alongside their partners and investors. In total, you have $654 million out of the $1.3 billion, which is pretty much like a 50% net income margin. This is it. This is the income statement. You don't have any research and development. You don't have anything kind of crazy, no crazy stock-based compensation or whatever. And this is the beautiful part about owning BAM, BN, and all these kind of businesses under Bruce Flatt, is he's not going to dilute you as a shareholder. He's not going to do some kind of a stock offering and crash the stock by 50% to acquire some overvalued company. He's not like that. He is well known for taking care of shareholders, especially taking care of shares outstanding. And shares outstanding only go down, they don't go up. And it's just a beautiful business model, as you could see here. Very simple, very easy to read from the company. Now, if you look at the scale of the business, this is how much demand there is. They have $119 billion of unallocated commitments. So this is $119 billion pretty much sitting there that's not invested, where the company is looking for an opportunity to invest this $119 billion. Now, if this $119 billion was to be invested, they would collect an extra $520 million in fees if they were to find a place to invest the money. And they're looking for places to invest the money. But this is a problem that this company have. They don't have a problem raising money. They have a problem finding places to put the money in. This is the problem they're having, which is actually a good problem to have. And it just tells you the demand that this company is experiencing. The company has $1.4 billion in liquidity in terms of cash, short-term investments, and credit facilities and other things. And as I mentioned, they take a portion of the free cash flow, and sometimes they invest it alongside their partners through their real estate investments and credit investments. So they have skin in the game, but they also collect some returns on their own cash. And that has been amazing from Brookfield Asset Management. Now, the main concern with BAM and BN in general is, what if we have a liquidity event? What if we have a financial crisis? What if we have something happen and then investors pull their money out? If they pull their money out, then the business is worthless. And this is a very valid concern, actually, and I will share your concerns. But you have to understand something, is that 87% of the capital of Brookfield Asset Management, the fee-bearing capital, they call it, which is $514 billion. 87% is permanent or long-term in nature. Now, what does long-term or permanent means? They explained it in the annual report, and I'm going to try to show you some snippets. This is what they said. As of December 31st, 2024, we had fee-bearing capital of $539 billion, of which 87% is long-dated or perpetual in nature, providing significant stability to our earning profile. And they said, which are typically commitments for at least 10 years with 2 one-year extension options. So most of those commitments, 87% of them, have a 10-year commitment with extensions. So they have a commitment where if there is some kind of a liquidity event, they just can't call BAM and say, I want my money back. there's more stability to the BAM business model. But you also have, I believe, 120 or 130 billion dollar that's BN's money invested in BAM. So this is permanent, it's not going anywhere. And BAM itself has its own money invested in the project. So a lot of it is permanent, where BAM is managing BN's money, but then you also have BAM, which is managing other people's money and other institutions' money, and it's locked into a 10-year commitment. So it's kind of shielded against some kind of a major liquidity event or some kind of event that's going to take the stock down to zero or something crazy. It's highly unlikely. There's so much money in the system that the problems they're having isn't getting the money, but it's where to actually put it. This is a problem that BN and BAM is actually having. Okay. Now the company's metric, which you could look at, it's a very simple metric. It's a little bit of adjustments, nothing too crazy, but it's DE, which is distributable earnings. They expect distributable earnings to grow 18% CAGR from 2024 to 2029. So 18% a year from now, you could say, to 2030. So 5 years from now. Now the multiple, if you look at it, it's around, I believe, 34 times. 34 times for 18% a year growth, around 54% net income margin for such kind of growth is really not expensive at all for a company like Brookfield Asset Management. So excluding any multiple expansion, excluding any multiple contraction, we will likely get an 18% annual return, which is close to the distributable earnings per share. Plus you have the 3.2% dividend on top of the 18%. So in total, I would say with BAM, you could get around a 20% annual return over the next 5 years. And those returns and this estimate is excluding potential carried interest. So if BAM was able to deliver a return that exceeds a certain amount, they would collect a few $billion extra in carried interest. I believe it's $2 or $3 billion by 2029 and $7 billion by 2034. So the CAGR could be much higher than 18%. So that excludes a lot of the growth. So minimum 18% CAGR. On the maximum, it's much, much higher. And as of the last quarter, I showed you guys, the company is growing much more than 18%. In fact, DE grew 20%. So it's growing much, much faster, and it will likely grow much, much faster in the future as the company is getting more inflows. And by the way, I'm using FinChat to come up with my chart. So if you want to try it out, they give you 2 weeks of free access if you want to use my link in the description. But if you want to look at BAM versus BM, this is a good comparison. And over the last 2 years, since 2023, BAM, this is adjusted for dividends. So if you look at the chart, it says adjusted for dividends. So if you adjust for the dividend, BAM has outperformed BN if you adjust for those dividends. But then in some countries, you have taxes. In the United States, it's like 15% on Canadian income, dividend income. Outside the US is 30%, so you have to look at your own country. But BAM has outperformed BN, and this is something that's worth noting. But I believe the future could be a little bit different, where BN could potentially outperform BAM, and I'm going to tell you why. And that was a long one, but this is the first part of their business. The second part of their business, which is very exciting, this is the insurance business. The insurance business, they're pretty much copying what Warren Buffett did at Berkshire Hathaway with investing the float. You hear the float all the time. The float is pretty much the total claims. So whenever you pay a premium, as an insurance company, they collect the premium, they invest the premium, and they get a return on it until someday some accident happens or something happens. Then you have to pay out the claims. But that's maybe years and years in the future. From now until then, you pretty much have an interest-free loan or a very low interest loan for you to invest and make money on. And this is what Brookfield is actually doing, where they're getting the float, they're reinvesting the float, they're getting a little interest to no interest loan, and they're making massive returns on it. I believe like 2 or 3% difference between the interest. They said a 2% interest difference, and to them it's like free money. It's not their own money, and they're making returns on it in a low risk way, and it's generating massive returns and massive return on capital. And this is something that Warren Buffett did, and Bruce Flatt is copying it within the BN business model. And they expect the insurance assets to grow from $110 billion to $300 billion by 2029. So this is almost a 3x. That would be insane for the company. Now, my least favorite part of the business is the real estate business. And this is why I was bearish on BN early on, I believe it was in 2023, I was seeing them default on a lot of commercial buildings, office buildings, many different buildings. And the problem with that is they get a commercial loan, let's say for 25 years. It's locked in 5 years at a fixed interest rate. Let's say it's 3%. Okay. Now, after 5 years, it readjusts, it becomes a variable interest rate. So they would have to refinance it again at whatever the current rate is. And that works really well whenever interest rates have been declining for the last 20 years. But as interest rates started rising, BN locked in, let's say, 2% interest rates in 2021. Okay, but here comes 2025, they have to refinance. The 2%, they're now paying 6 or 7%. The deal is not making sense. They're having to default on it. Now, the good thing is their debt is non-recourse, so they can walk away and they're not liable for paying the remaining of the loan. And I was not a big fan of the business model. I don't like it at all. I still don't like it at all. But the good thing is BN is realizing that, and they are slowly selling down their real estate portfolio, and they're getting out of this, which what I believe is a terrible business, especially in a rising interest rate environment. And that's what's changing my mind on BN, is if you look at their projection of generating $47 billion in cash flow over the next 5 years. Most of it is expected to come from the asset management business. This is Brookfield Asset Management. Then the wealth solutions, which is reinvesting the float of the insurance assets. Then they have the realized carried interest, where if they hit their milestone on certain goals, return goals, they get paid extra fees on top of that. And then they have the operating businesses, which is a tiny fraction, which is real estate business, of the total free cash flow. So this is why I'm liking BN much, much more, because they decided to focus more on insurance, focus more on Brookfield Asset Management, instead of focusing on more on real estate, which is something that I'm not a big fan of at all. Now, if we combine it all together, this is what BN looks like from 2024 on their expectations to 2029. They expect the BAM business and their direct investments together, as BAM is expecting to grow their DE, distributable earnings per share, 18%. BN is expecting to get an 18% CAGR from that. It's very simple. Okay. Now they have the wealth solution, which is going to 3x over the next few years, and they combine it with the operating businesses, which is pretty much stalling. But in total, from the wealth solutions and operating businesses, they expect a 28% CAGR in distributable earnings per share. In total, that would take their distributable earnings per share from $2.94 to $6.33, or a 17% CAGR. Okay, the stock right now is trading at 21 times trailing earnings. If I take the 21 times, very simple, I take the 633, which is expecting by 2029, and I time it by 21 times forward earnings, I get $132 per share. The current price is $62 per share. This is more than 100% on the upside over the next 4 years, pretty much, with an amazing company like BN. Now, there's a kicker with that. Is this estimate from BN does not include the potential realization of the carried interest that I told you guys about, which is if they hit certain milestones of potential returns within their funds and other investments, and their capital allocation, which they do take a portion of the free cash flow and they reinvested in the business, they reinvested in themselves and in other kind of things. That has nothing to do with those estimates. All those things are extra. Now, those are hard to account for. So I would say BN, the minimum return, is a double over the next 4 years, or around a 15 to 17% CAGR. Easy, in my opinion. Now, if you want to include everything together, so you want to include the carried interest as you look over here, and you want to include the capital allocation, it's much, much higher than the $6.33. The return would be $9.77 in distributable earnings per share by 2029, or a 25% CAGR. Okay, now in this case, the stock at $3.20 right now would be trading at 19 times trading earnings. And if the stock is expected to grow at 25% CAGR, including everything on the best case scenario, then you're paying less than 1 times growth for such an amazing company. So the stock is dirt cheap. So in this case, if we assume no multiple expansion, no multiple contraction, I take $9.77, okay, and I time it by 19 times earnings, which is the current trailing multiple, I'm getting around $185 per share from this price. The stock right now is trading at $62. This is almost 200% on the upside, or almost a 3x over the next 4 years, with a amazing high quality company like BN, with a CEO like Bruce Flatt, was just an amazing company. This is mind blowing. I've looked at so many investments in this market, so many stocks, Google and many others. They're amazing companies, but I haven't seen any stock with such an amazing risk to reward setup. Not just in terms of a base case scenario, which is a double over the next 4 years, but with such an amazing call option where there's a very high chance that they will realize the carried interest. I mean, they even said that they already expect to do so, but I'm not taking it into consideration. But if you want to take the best case scenario and they do realize the carried interest, everything goes well, everything goes as planned, which normally it does, and it normally even exceeds expectations. Now, in this case, no multiple expansion, no multiple contraction. You could get up to 200% on the upside over the next 4 years, not with a speculative small cap stock or a growth stock, but with a company like Brookfield. So to me, I love the company very much. I like it. It's one of the best stocks in this market. I would say in this expensive market at this multiple, amazing stuff. I really, really like it. And I promise you guys, I did it. And I'm just saying my opinion here. I used to be a hater of BN, especially when I was so focused on real estate business. But as the insurance business is growing, I'm a fan right now. I'm a fanboy, So I like the company very much, and again, I'm a big fan. I like it, and that's my honest opinion as always. And it wasn't financial advice, so I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.